Welcome to this presentation by the James Smith Company on understanding self-directed IRAs. In this segment, we're going to focus on IRA rollovers and conversions. For more useful real estate investing advice and retirement planning information, please be sure to visit our website at jamessmithseries.com. James Smith's company and affiliates are providing this information for general educational purposes only. Before making any decisions regarding tax, business, estate, or financial planning, please consult a respectively licensed professional. First, let's discuss the difference between an IRA rollover and a conversion. A rollover occurs when money is transferred from a non-IRA retirement program into an IRA retirement program. An example of this would be if funds were transferred from a 401k into a traditional IRA. Our conversion is a little different. It occurs when money is transferred from an IRA retirement program into another IRA retirement program. An example of this would be if funds were transferred from a traditional IRA into a Roth IRA. It's important to know that there's something referred to as an IRA recharacterization. This occurs if a person needs to reverse a conversion and transfer funds from a Roth IRA back into the IRA program that they converted the funds from. So let's discuss some IRA rollover rules. Most IRA rules only allow for a single rollover transaction within a 12-month period. A rollover is allowed to take up to 60 calendar days. The respective custodians involved in the transaction will oftentimes assess fees for the necessary paperwork involved. And finally, most rollovers involve direct monetary transfers from one custodian to another. Now let's discuss the concept of a tax-free withdrawal. A tax-free withdrawal is a strategy where you have an IRA with funds inside of it. And rather than rolling the funds directly from one custodian to another custodian, you as the investor elect to roll the funds into your personal account. You see, the IRS doesn't have very strict guidelines on where the funds can be and what the funds can be used for during the rollover time period. So you roll the funds over into your personal account, and you're going to utilize them really for whatever purpose you want, as long as within the 60 days, the funds go back into the IRA custodian. Now, some investors elect to take funds from their IRA, roll them over personally, utilize them, but when it's time to put the money back into a retirement program, rather than simply putting it into one retirement program, they decide that they want to put it into two retirement programs. You may actually see individuals do that more commonly this upcoming year in 2010 because they may take funds out of a traditional IRA, utilize them personally, and then put half back into the traditional IRA and then half over into the Roth IRA so that they don't have to pay taxes on the conversion all in one year. A very important note is that you only have 60 days to utilize the funds. Within the 60-day time period, the funds have to be back into a qualified retirement program account. If they're not, you are going to pay penalties and fees and potentially taxes as well. So it's important to comply with the 60-day time frame. Now let's discuss some IRA conversion rules. When money is converted from a traditional IRA to a Roth IRA, it's going from tax-deferred account to a tax-free account. Because Roth IRAs require you to pay tax up front, the money in the account has already been taxed. Therefore, you're not going to get taxed on it again. No sense in being double taxed here. Therefore, when you transfer money from a non-Roth IRA into a Roth IRA, the conversion amount will be considered earned income and added to your adjusted gross income. Therefore, you'll be taxed on the combination of your actual earned income and the amount that you're converting. This is why when someone does a rollover, they may decide to put half of it back into their original IRA and put half of it over into a Roth IRA. That's an instance where you'd see someone split it up half and half. Now let's discuss some IRA conversion rules. Generally, you can convert your non-Roth IRA, for example, traditional SEP or Simple, into a Roth IRA if your adjusted gross income is $100,000 or less. Now, commonly, when people are referring to your income levels with respect to being able to qualify for conversion, they refer to something known as a modified adjusted gross income. To figure out what your modified adjusted gross income is, be sure to refer to your tax professional. In the 2010 tax year, there's no limitation on adjusted gross income with respect to your ability to qualify for a Roth IRA conversion. This is a very special exception, and it's for 2010 only. Now let's say we have Joe, and Joe's a single guy with an adjusted gross income of $60,000. Now in a common year, if he earns $60,000 and that's his gross, that's all the taxes he's going to pay. But this year, Joe is going to convert $10,000. So because the $10,000 conversion is going to be looked at as earned income, his new taxable income is $70,000. Now you may be asking, does he qualify for the conversion? Yes, he does, because he's under the $100,000 cap. So again, Joe qualifies because his income is less than the $100,000 cap. Now let's take a look at another person. Here we have Sue. She's married and she makes $120,000 in a year. She's wanting to convert the same amount that Joe was, $10,000. At the end of the year, when it comes down to her taxable income, it's only going to be $120,000 because she does not qualify. The reason she doesn't qualify is because her adjusted gross income is simply too high. It exceeds the $100,000 cap. Now it's important to note that in 2010, Sue would actually be able to qualify for the conversion because in 2010 and in 2010 only, an individual's modified adjusted gross income is not going to impact their ability to have a conversion. So that's very important to note that in 2010 there is an upcoming exception. Now let's discuss a rollover and a conversion recap. So let's say you have a traditional 401k, traditional IRA, and a Roth IRA. If you take funds from your traditional 401k and move them into your traditional IRA, this is called a rollover. If you transfer funds from a traditional IRA into a Roth IRA, this is referred to as a conversion. If you take the funds from the Roth IRA and move them back to the traditional IRA, this is known as a recharacterization. And finally, if you roll the funds over to you personally for a 60-day time period and then roll them back, this is referred to as a tax-free withdrawal. For more helpful real estate investment advice and retirement planning, please be sure to visit our website at jamessmithseries.com.